Principle. Welcome to Echo 312, Principle of Accounting. Studies Section 1. Adjustment to Final Account. Introduction. You are now familiar with the application of double entry and extraction of trial balance. Before you prepare the final account from the trial balance, you need to make some adjustments that will ensure that the final account that you will prepare shows a true and fair view and conform to the Generally Accepted Accounting Principle, GAAP. The usual adjustments include closing stock, prepayment, accrual, bad debt, and provisions. We will explain how to effect these adjustments in this lecture. Objectives. At the end of this lecture, you should be able to 1. Identify the items that require adjustment when preparing the final account, and 2. Effect the required adjustment. Pretext. 1. List 7 items that require adjustment in the preparation of final accounts. 2. Explain how you would carry out adjustment in any 5 of the items listed. Content. A. Closing stock. This is the stock of goods that remain unsold at the balance sheet date. In the trading account, you will deduct the value of closing stock from the cost of goods sold. In the balance sheet, you will record the closing stock as part of the current asset. B. Prepaid expenses. These are the expenses that you have paid for in advance. They are expenses that you will enjoy their benefit in future accounting period, but which you have paid for as at the trial balance date. In the profit and loss account, you will deduct the prepayment from the expenses figure shown in the trial balance. In the balance sheet, you will show the prepaid expenses as current asset. If prepaid expenses figure is included in the trial balance, it represents expenses that was paid for in the previous accounting period for which the benefit is derived in the current accounting period. Therefore, such figure should be added to the respective expenses figure in the profit and loss account. C. Accrued expenses. These are expenses owing as at the balance sheet date. They are expenses that are due for payments but which you have not paid for as at the balance sheet date. In the profit and loss account, you will add the accrued expenses to the expenses figure shown in the trial balance. In the balance sheet, you will show the accrued expenses as current liabilities. If accrued expenses figure is included in the trial balance, it represents expenses that was due for payment but which you did not pay for as at the beginning of the current accounting period. The benefit was enjoyed during the previous accounting period and should therefore be deducted from the respective expenses figure in the profit and loss account. D. Income received in advance. These are income that you received in advance of its due period. They are income not yet due but which you have received as at the balance sheet date. In the profit and loss account, you will deduct the income received in advance from the income figure in the trial balance. In the balance sheet, you will show the income received in advance as current liabilities. E. Accrued income. These are incomes that are due but are received as at the balance sheet date. In the profit and loss account, You will add accrued income to the income shown in the trial balance. In the balance sheet, you will show the accrued income as current asset. F. Bad debt. This is part of the debt that you consider irrecoverable. The reasons why you can declare debt as bad include death, bankruptcy, and incapacitation of the debtors. If the bad debt is shown in the trial balance, you will only charge it as expenses in the profit and loss account. But if you have bad debt as part of the additional information, you will charge it as expenses in the profit and loss account, and you will also deduct it from the debtors figure in the trial balance. G. Provision for bad and doubtful debt. This is a fair estimate of the share of the debts that may become irrecoverable in the future. Though it is almost certain that some debts will be irrecoverable, you are never certain of the actual amount that will become irrecoverable. The factors that you will consider in making this provision include the character of the debtors, customers' paying ability, and the general economic condition. When you provide for a new provision for bad debt, you will charge it as expenses in the profit loss account and deduct it from the debtors balance under the current asset in the balance sheet. When you increase the provision for bad debt, you will charge the increase as expenses in the profit loss account and deduct the new increased provision figure from the debtors balance in the balance sheet. When you reduce the provision for bad debt, you will post the decrease as income in the profit loss account and deduct the new reduced provision figure from the debtors balance in the balance sheet. When provision for bad debt is in the trial balance, without requirement to increase or reduce it, you will only deduct the figure from the debtors balance in the balance sheet. I. Provision for discount receivable on creditors. This is a fair estimate of a rebate that you will receive from creditors for making payment within a stipulated period. When you provide for a new provision for discount receivable from creditors, you will record the provision as income in the profit loss account and deduct it from creditors balance under the current liabilities in the balance sheet. When you increase the provision for discount receivable, you will record the increase as income in the profit loss account and deduct the new increased provision figure from creditors balance in the balance sheet. When you reduce provision for discount receivable, you will charge the decrease as expenses in the profit loss account and deduct the new reduced provision from creditors balance in the balance sheet. J. Provision for depreciation. This is a fair estimate of the part of the fixed non-current asset consumed during the accounting period. When you make a new provision for depreciation, you will charge it as expenses in the profit loss account and deduct it from the historical cost of the asset in the balance sheet. When you make additional provision in the subsequent years, you will charge the new provision as expenses in the profit loss account and deduct the total accumulated depreciation in the balance sheet. K. Drawings. This is the value of cash, goods, or any other property of the business that the owner takes for his private use. Where drawings had been recorded in the book, it will appear on the debit side of the trial balance. You will deduct the balance on the drawings account from the capital section of the trial balance. To account for drawings of goods at cost price, you will debit drawings account and credit purchases account. To account for drawings of cash, you will debit drawings account and credit cash or bank account. To account for drawings of other assets, e.g. motor vehicle, you will debit drawings account and credit the respective asset account. 1. Correction of errors. Sometimes you may need to make corrective entries on some figure in the trial balance and prepare the adjusted trial balance before you prepare the final account. We will treat the correction of errors in detail in another lecture. Example: basic adjustment. Below is the trial balance of Lambert stores for the year ended 31st December 2007. Below is the trial balance of Lambert stores for the year ended 31st December 2007. Debit in Naira, credit in Naira. Debtors and creditors. Debit 39,000, credit 17,300. Stock 31/12/2006, debit 23,700. Carriage outward, debit 2,000. Carriage inward, debit 3,100. Returns, debit 2,100, credit 3,200. Purchases and sales, debit 118,700, credit 186,000 naira. Provision for bad debt, credit 800. Salaries and wages, debit 38,600. Rent, debit 3,000. Provision for discount allowed, credit 700. Discount allowed / discount received, debit 1,000, credit 1,200. Insurance, debit 1,000. Motor expenses, debit 6,600. Office expenses, debit 2,200. Lighting expenses, debit 1,700. General expenses, debit 3,100. Cash, debit 900. Bank 4,800. Drawings, debit 12,000 naira. Capital, credit 127,500. 5% bank loan, credit 20,000. Accrued expenses, salaries, credit 13,300. Buildings, debit 60,000. Motor vans, debit 18,000. Furniture, debit 8,500. Investment, debit 20,000. Total debit 370,000 naira. Total credit 370,000 naira. Additional information: 1. Closing stock was valued at 29,500 naira. 2. A bad debt of 4,000 naira was written off. 3. Accrued expenses: rent 2,000 naira, insurance 1,000 naira. 4. Provide for depreciation on motor van at 10%. 5. Maintain the provision for bad debt and the provision for discount allowed at 5% and 1.5% respectively on debtors. 6. Lambert drew some goods for personal consumption valuing 1,700 naira. 7. Dividend received on investment 5,500 naira check. 8. As at 31/12/2007, the advance payments were 5,000 naira and 600 for salaries and motor expenses respectively. You are to prepare the trading profit and loss account for the year ended 31st December 2007 and a balance sheet as at that date. Solution. In the book of Lambert, trading profit and loss account for the year ended 31st December 2007. Sales in Naira, 186,000 Naira. Less return inward, 2,100, making 183,900. Less cost of goods sold. Opening stock, 23,700. Purchases, 118,700. Add carriage inward, 3,100. Making 121,800. Less return outward, 3,200. Net purchases, 118,600. Making 142,300. Less goods drawn, 6, 1,700. Cost of goods available for sales, making 140,600. Less closing stock, 1, 29,500. Cost of goods sold, 101,100. Gross profit, 72,800. Add other incomes. Dividend received, 7, 5,500. Decrease in provision for discount allowed, 5, 175. Discount received, 1,200. Total 79,675. Less operating expenses. Administrative expenses. Provision for depreciation on motor vans, 4, 1,800. Salaries and wages, 8, 20,300. Rent, 3, 5,000. Insurance, 3, 2,000. Motor expenses, 8, 6,000. Office expenses, 2,200. Lighting expenses, 1,700. General expenses, 3,100. 42,100. Selling and distribution expenses. Bad debts, 4,000. Increase in provision for bad debt, 5, 950. Carriage outward, 2,000. Discount allowed, 1,000 to 7,950. Finance expenses. Interest on loan, 9, 1,000. Total operating expenses, 51,050 Naira. Net profit, 28,625. Balance sheet as at 31st December 2007. Cost, account depreciation, NBV in Naira. Fixed assets. Buildings, cost 60,000. NBV 60,000. Furniture, Cost 8,500. NBV 8,500. Motor vans 4. Cost 18,000. Account depreciation 1,800. NBV 16,200. Total cost 86,500. Account depreciation 1,800. Total NBV 84,700. Investment NBV 20,000. Current assets stock 1. Account depreciation 29,500. Debtors 2, 5. Account depreciation 32,725. Prepayment salaries and wages 8. Cost 5,000. Motor expenses 8. Cost 600. Account depreciation 5,600. Bank 7. Account depreciation 10,300. Cash 900. Total 79,025. Less current liabilities. Creditors cost 17,300. Accruals interest on loan 9. Cost 900. Rent 3. 2,000. Insurance 3. Cost 1,000. Accrued depreciation 21,300. NBV 57,725. Capital employed 162,425. Financed by capital NBV 127,500. And net profit 28,625. Total 156,125. Less drawings 6. 13,700. Net worth capital home 142,425. Add long-term liabilities. 5% bank loan 20,000. Capital employed 162,425 as the total. Explanatory notes. 1. The treatment of closing stock is as described before. See 1.4a. 2. The bad debt figure is part of expenses in P&L and also deducted from the debtors balance. Debtors balance is equal to 39,000 to 4,000 is equal to 35,000. See 1.4f. 3. Accrued expenses are treated as described in section 1.4c. In the P&L account, rent is equal to 3,000 plus 2,000, which is equal to 5,000. Insurance is equal to 1,000 plus 1,000 is equal to 2,000. 4. Depreciation on motor van 10 over 100 times 18,000 is equal to 1,800. 1.4g. 5. New debtors balance is equal to 35,000. New provision for bad debt is equal to 5 over 100 times 35,000 is equal to 1,750. Old provision for bad debt is equal to 800. Increase in provision for bad debt is equal to 950. New provision for discount allowed is equal to 1.5 over 100 times 35,000 is equal to 525. Old provision for discount allowed is equal to 700. Decrease in provision for discount allowed is equal to 175. New debtors balance is equal to 35,000 minus 1,750 minus 525 is equal to 32,725. 6. This is the case of drawings of goods. New drawing balance is equal to 12,000 plus 1,700 is equal to 13,700. See 1.4K. 7. This is an error of omission. Correcting this error will increase income in P&L account and increase bank balance current asset in the balance sheet. 8. These are prepaid expenses. See 1.4b. In the P&L account, salaries is equal to 38,600 minus 5,000 minus 13,300. 1.4c is equal to 20,300. Expense is equal to 6,600 minus 600 is equal to 6,000. 9. The 5% bank loan in the trial balance means that interest of 5% per annum is payable on the loan. There is an implied accrued expense in relation to the interest on loan. Accrued interest on loan is equal to 5 over 100 times 20,000 is equal to 1,000. Summary. In order to prepare final account that will show a true and fair view and conform to the generally accepted accounting principle GAAP, you need to make some adjustment to the figure in the trial balance. These adjustments include prepaid expenses, accrued expenses, income received in advance, accrued income, bad debt, provision for bad and doubtful debt, provision for discount allowed on debtors, provision for discount receivable on creditors, provision for discount receivable on creditors, provision for depreciation, drawings, and errors. This is the end of study section 1. Thanks for listening.